Now, next product in line is a asset-backed credit-linked note, or a CLN for short. Again, a very popular product, and this product is such that it creates a security which is nothing but a default swap which is embedded with a certain fixed income product, for example, a bond. Now, the main point to remember here, and also for your examination, is CLN is an on-balance sheet product because most of the derivatives which you will see, forward, swaps, etc., all of these will be included in your off-balance sheet book, or they will give to what we call as the off-balance sheet exposure. However, CLN sits on the balance sheet, and that's why the accounting treatment for them will be slightly different. So this is one point to be remembered. Many a times when we talk of derivatives, we simply say, yeah, and they are an off balance sheet, but for a CLN, that isn't the case. So this is very much an on balance sheet product with exchange of principal. However, the ownership of the underlying product does not change hands, although the principal is being exchanged. The investor of this particular CLN will not be exposed to any kind of margin calls. Also, at the same time, it is going to offer leverage. So we'll talk a bit about the leverage bit when we look at the block diagram for the CLN. Now, banks will generally get a credit rating which is done for CLN. This is because whenever such a product is structured by the bank, in order to make this product appealing to the investor, they would want to have a certain rating which is done on these products. So that is precisely the reason why most banks will try to do ratings for many products. So this is also what we call as external enhancements, which a bank or an issuer would do in order to make that product more appealing to the market. Because whenever you have a certain product which has been given a rating by a certain credit rating agency, that improves the perception of that product in the minds of investors, and there is a larger probability that the investor will purchase the product. So that's why banks will always try to improve their uh, and improve the chances of that product being subscribed by the investor through getting them rated by a proper rating agency. Now, this is a structure for a CLN. So let's try to understand these things. So we'll break this into three parts. We have a bank, next is we have a trust, and the third is the investor. So a bank, a trust, and an investor. So the bank is going to purchase the underlying asset. So let's say the asset is worth $105 million, sorry. So bank purchases the asset, and the financing of this asset will be done at LIBOR. So that will be the cost of funding for this particular asset. Once bank purchases this asset, it will place this inside a trust. And now this underlying we are assuming to be non-investment grade. Let's say these are non-investment grade loans. So they are risky loans. But whenever we have a risky loan, we'll have a certain higher yield which we expect, isn't it? So that is what we write here. So the expected coupon is LIBOR plus 250 pips. Now, once this has been created, the bank will start marketing these products to its investors. So those investors who are interested or who have the risk appetite for such products will naturally have an inclination towards purchasing them. So once a bank finds an investor who's interested in them, then the investor will be expected to place a certain collateral. So that we have shown by via $15 million. So this is the collateral which has been posted by the investor with the bank. That is, the $15 million will be parked inside US Treasury notes or US government securities. And let's say the government securities are yielding 6.5%. And once the investor purchases this product, a CLN certificate will be issued to the investor. So this is the rough structure. Now let's try to understand the cash flows which are embedded. So those are given in the subsequent table. So I've included them together so that we can have a look at the entire cash flow exchange in one shot. But now, since we have covered this basic structure, relating this to the cash flows will be easy. So starting from step one, the bank is purchasing the underlying assets at 105 million and they are placing this inside a trust. The cash outflow of the bank will be the cost which the bank has to pay. So the cost or the financing is done at LIBOR. Now the yield expected on this particular asset is LIBOR plus 250 basis point because we are assuming non-investment grade loans, so they are naturally expected to give a certain higher yield, which we call as L plus 250 or LIBOR plus 250. Next, once the bank finds a potential investor who is interested in this product, then the investor is expected to post a certain collateral. So here we have taken a hypothetical value of $15 million, which will be placed as collateral inside the trust. This collateral will be invested in US government securities. Now, the leverage which the investor gets here is 105 by 15, which is a leverage factor of 7. So this is the same leverage point which we briefly spoke about earlier. Now, what do we mean by leverage? So again, this is a term which is used many times when we talk of risk analytics or maybe quant analytics in general. So a very simple way to understand leverage is I'll just draw two wheels. So let's say this is my wheel 1, which is the smaller wheel. And let's say I have a wheel 2, which is the larger bit. And I'll connect a plank between the two. So this plank has been connected so that these two weights are connected with each other. Now, this is a very crude way of explaining leverage, but it's a very effective way. For those of you who are studying leverage for the first time, this will give you an immediate understanding of what leverage implies. So what we are doing here is we are making a very small investment, and through that small investment, we are getting a chance to enter into a very large position inside a derivative transaction. So if we relate it to the numbers which are given here, you can imagine the quantum of W1 is just 15 million, whereas the quantum for W2 is 105 million. So that is what I call as leverage, because just by parking $15 million, the investor is getting a chance of taking a position in a much larger asset. So the actual asset value is 105. So that is giving them a leverage, and you can imagine this is the plank which provides the leverage. So in our case, the leverage factor is 7. So again, so this is how leverages are frequently used by market participants. Now let's understand the cash flows from both perspective, bank as well as the investor. So for a bank, the inflows will be LIBOR plus 250 basis points, which we expect from the underlying loan pool. Next would be the funding cost, which has to be deducted. So the funding is happening at LIBOR, so we deduct LIBOR from this. And next is a payment which we have to do to the trust, which is 150 basis points. So by solving this simple equation, we come out to a value of 100 basis points. So 100 basis points is the compensation for the bank for taking on this product, because bank is also taking a risk on this product, isn't it? Because in case the investor uh, in case the loss exceeds beyond what the investor has parked, now the bank will be expected to manage that loss. So that is a risk which the bank is willing to take. And for that, bank requires a compensation, which is 100 basis. Now, from an investor perspective, let's assume that 6.5% is the yield on the government security, plus the 150 basis points from the trust into the leverage factor. This will give us to a total return of 17% for the investor. Now, here we see the impact of leverage, because as we spoke earlier, now this product gives an unlimited leverage. Now, if the investor is willing to put in more leverage, then naturally that is going to magnify the returns. But of course, the more the leverage, the riskiness of the product also increases. But that will have an impact on the returns in some way. So that way, and more the leverage, the higher would be the expected return, a simple relation. So this is the cash flow expected from the investor's point of view. Now, it's also beneficial to understand from a loss perspective, to understand what is the maximum loss which the counterparties will be exposed to. So for an investor, the maximum loss is just $15 million, which is the collateral which the investor has pledged. Whereas for the bank, assuming that the investor defaults, it will be any loss which exceeds the collateral, which is anything in excess of $15 million. That loss is something which the bank will be exposed to. And that is precisely the risk which the bank is carrying. And because of this risk, the bank has to be compensated, which we show by this 100 basis point payment which is paid to the bank.